Hey traders, welcome back to the channel. I'm Trader D, and today we're starting an exciting new journey into the world of chart patterns. We've just wrapped up our candlestick series. So we're diving into the world of chart patterns. These patterns are crucial for making informed trading decisions, whether you're looking for reversals or continuations in the market. By the end of this video, you'll have a solid understanding of various patterns and how to interpret them effectively. Let's get started. Reversal patterns. Head and shoulders, inverse head and shoulders, double top, double bottom, triple bottom, rounding top, rounding bottom. The head and shoulders pattern is one of the most reliable bearish reversal patterns. It consists of three peaks, a higher middle peak, the head, and two smaller side peaks, the shoulders. This pattern usually forms at the top of an uptrend, signaling that the market may reverse into a downtrend. Imagine a stock that has been trending upward for weeks. You notice the formation of the head and shoulders pattern, with the right shoulder failing to push higher than the head. Once the price breaks below the neckline, it's your signal to enter a short trade, expecting the market to move lower as the trend reverses. How to read head and shoulders pattern. In this chart, left shoulder, the first peak forms during an uptrend, but after this peak a pullback occurs, indicating initial selling pressure. The next peak is higher than the left shoulder, showing strong buying pressure. However, this is followed by another pullback, suggesting the start of buyer weakness. The final peak is lower than the head, and is followed by a pullback, signaling that buyers are losing momentum. The line connecting the two pullbacks between the left shoulder and the right shoulder, usually sloping upward or flat, when the price breaks below the neckline, it confirms the reversal, indicating a shift from bullish to bearish momentum. Inverse head and shoulders pattern. The inverse head and shoulders pattern is the bullish counterpart to the head and shoulders pattern. It indicates a reversal from a downtrend to an uptrend, often forming at the bottom of a bearish move. It consists of three troughs. The middle trough head is lower than the two side troughs shoulders. Imagine a market that's been falling for some time. You see the inverse head and shoulders pattern forming, and once the price breaks above the neckline, you take a long position, anticipating a reversal to the upside. How to read inverse head and shoulder. The first trough forms during a downtrend, but is followed by a slight, showing temporary buying pressure. The next trough is lower than the left shoulder, representing stronger selling pressure. However, this is followed by another rally, suggesting buyers are starting to step in. The final trough is higher than the head, indicating that sellers are losing strength, followed by another upward move. The line connecting the peaks between the left and right shoulders, a breakout above the neckline, confirms the bullish reversal, signaling that the market is likely to move upward. Double top pattern. The double top is a bearish reversal pattern that occurs after an uptrend, signaling a shift in market sentiment from bullish to bearish. The pattern consists of two peaks at roughly the same price level, separated by a pullback. Imagine a stock that's been in an uptrend, and after hitting a new high it pulls back slightly. When it attempts to rise again, it fails to break the previous high, forming a double top. Once the price breaks below the neckline, you enter a short trade, anticipating a bearish reversal. How to read double top. After an uptrend, the price reaches a peak and then pulls back. The price rises again but fails to break the first top, forming a second peak at a similar price level. The line connecting the low point between the two peaks, a break below the neckline, confirms the reversal and signals a potential downtrend. The double bottom is a bullish reversal pattern that signals a shift from a downtrend to an uptrend. It consists of two troughs at roughly the same price level, indicating that selling pressure is diminishing. Imagine a currency pair that's been falling, and after hitting a low, it starts to bounce back. The pair tries to drop again but holds above the previous low, forming a double bottom. Once the price breaks above the neckline, you enter a long trade, expecting a reversal to the upside. How to read double bottom. After a downtrend, the price hits a low and then bounces upward. The price drops again but fails to break the first bottom, forming a second low at a similar price level. The line connecting the highs between the two bottoms, a breakout above the neckline, confirms the bullish reversal. The triple top pattern is a bearish reversal pattern that forms after an uptrend. It consists of three peaks at approximately the same level, indicating that the buying pressure is weakening and a reversal into a downtrend is likely. Imagine a stock in an uptrend that forms three consecutive peaks, each at roughly the same level, followed by pullbacks. After the third peak, the price fails to break higher and instead breaks below the neckline, signaling the start of a downtrend. How to read triple top pattern. First peak, the stock reaches a high followed by a pullback. Second peak, the price rises again to the same level but pulls back. Third peak, the price fails to break higher once more, indicating weakening momentum. Neckline, the support level formed by the lows of the pullbacks. A break below this confirms the bearish reversal. The triple bottom pattern is a bullish reversal pattern that forms after a downtrend. It consists of 3 consecutive lows at approximately the same level, indicating that selling pressure is weakening and a reversal into an uptrend is possible. Picture a stock in a downtrend that forms 3 consecutive lows at about the same level, followed by rebounds. After the third low, the price fails to drop further and instead breaks above the neckline, signaling the start of an uptrend. How to read triple bottom pattern. First low, the stock falls to a support level and bounces back. Second low, the price drops again to the same support level but rebounds. Third low, the price tests the support level once more but fails to drop lower. Neckline, the resistance level formed by the highs of the rebounds. A break above this confirms the bullish reversal. The rounding top is a bearish reversal pattern that forms at the end of an uptrend. It looks like a gradual rounded arc, showing a shift from bullish to bearish sentiment over time. This pattern indicates that buyers are slowly losing control, and the market is likely to reverse into a downtrend. Imagine a stock in an uptrend that starts to lose momentum. Instead of sharp peaks, the price forms a smooth, rounded curve, gradually decreasing before breaking below a support level. This confirms the bearish reversal. How to read rounding top pattern. Beginning, the price rises in an uptrend, but the upward momentum gradually weakens. In middle, the price curves downward, forming a rounded top as buyers start losing strength. In the end, the price breaks below the support level, signaling the completion of the pattern and the start of a downtrend. The rounding bottom is a bullish reversal pattern that forms after a downtrend. It looks like a smooth, rounded arc, indicating that sellers are losing strength, and the market is likely to reverse into an uptrend. This pattern shows a gradual shift in market sentiment from bearish to bullish. Picture a stock in a downtrend where the price gradually forms a rounded curve at the bottom. After the curve completes, the price breaks above a resistance level, signaling a bullish reversal. How to read rounding bottom pattern. In the beginning, the price falls in a downtrend, but the downward momentum starts to slow. And in middle, the price forms a smooth, rounded bottom as selling pressure weakens and buyers start gaining control. The price breaks above the resistance level, signaling the completion of the pattern and the start of an uptrend. So today, we covered the key reversal signals you can use to anticipate market changes. But remember, this is just one part of a much bigger picture. Trading isn't just about memorizing patterns, it's about developing a strategy that works for you. Every trader has their own style, and that's what you need to aim for too. These patterns are tools, but the real key to success is combining what you've learned and applying it in a way that suits your trading goals and risk tolerance. The more you practice, the better you'll get at spotting these patterns in real charts, understanding market trends, and making smart decisions. I encourage you to try identifying these patterns on your own charts. Practice is essential to mastering trading, and the more familiar you get with recognizing these setups, the more confident you'll become in your trades. Remember, learning comes before earning. Stay focused on expanding your knowledge and refining your strategy. Thank you all for your continued support. If you haven't subscribed yet, make sure to hit that subscribe button to stay updated on all the latest trading tips and lessons. I'm Trader D, and I'll see you in the next video where we'll dive into continuation patterns. Keep learning, keep practicing, and most importantly, keep trading smart.